Good afternoon. This is Josh here at Chaikin Analytics, and I'd like to welcome you to our presentation of how I create winning option strategies. Presenting today is Marc Chaikin, founder of Chaikin Analytics. Chaikin Analytics is not registered as a broker-dealer or investment advisor either with the U.S. Securities and Exchange Commission or with any state securities regulatory authority. Chaikin Analytics is for educational purposes only. Past results of any trading system or methodology do not guarantee future results. As a reminder, this webinar is being recorded and a copy will be sent to all registrants tomorrow. If you have any questions, please submit your questions via the Zoom Q&A window, which you can access at the bottom of your screen. Now to get us started, here's Marc Chaikin.
Thank you, Josh, and welcome everybody. In this afternoon's webinar, I'm going to show you how I create winning option strategies. And actually creating the option strategies is something that we've made much easier by embedding a module called Options Play in Chaikin Analytics. The real challenge is finding the right stock. So we're going to focus on both of those in this afternoon's webinar. A little bit of my background: 50 years on Wall Street. Always believed that fundamentals drive the market, but for 45 years I've been using technical analysis, and that's helped me survive 10 bear markets. For 5 years, I ran the options department in a brokerage firm called Tucker Anthony, fine regional brokerage firm, now part of RBC, and tens of thousands of options traders trying to get an edge. And what we learned was that without an edge, very difficult to make money trading options. For us, the edge is the Chaikin Power Gauge rating. It really gives you what we call that directional edge. And I created the Chaikin Power Gauge rating in 2010, drawing on everything I had learned from my institutional clients over a 30-year period. I'm going to show you how the Power Gauge rating is constructed, why it's worked so well, and what it can do for you as an options trader. It's the culmination of my life's work. I started Chaikin Analytics in 2011 to level the playing field for traders and investors by giving them the same tools that I had created for institutional investors for over 30 years. I'd like to start off with a poll question. And Josh, why don't you take it over from here?
Sure, thank you, Marc. The poll question is, are you making money in 2019? Yes or no? I'll give you a brief time to get your votes in, and then we'll share the results with everybody. All right. Marc, let me share these with you and everybody listening.
Well, that's great, 74%. That's a very high number, and hopefully you've seen some of what Chaikin Analytics can do for you, because I know we have a number of our subscribers on the webinar. It's been a challenging year because the market went from being on an uptrend on autopilot through a good part of 2018 to a roller coaster of a correction. And that correction ended on December 24th. I call that the Christmas Eve massacre. What we're looking at here is a one-year chart of the SPY. It's the most actively traded instrument in the US market. It mirrors the S&P 500 large cap index. And what happened in the fall of 2018, as we came off that September peak, as I'm sure you know, had a very steep decline because of some inelegant comments from Jerome Powell, the new Federal Reserve chair, which spooked the market. And we bottomed out at 2,600 after breaking previous support at 2,800. Rallied back up to 2,800, came back to 2,600, rallied back up to 2,800 a third time. Back in December, we were looking for what's known as a W-shaped bottom, but then we ran into the perfect storm of negativity, in my view. We had tax selling for the first time since the bull market began in 2009. There were enormous hedge fund liquidations. And all of this came at a time when the market is typically very quiet, because in the vacation period, traders tend to go off with their families skiing or down to a warmer climate. And so heading into 2018's low on December 24th, we had the Fed talking about raising rates no matter what the economy was doing. We had a little glitch in the China trade talks and these aforementioned hedge fund liquidations. And the market just plummeted right through support at 2,600 and closed down at 2,350 on Christmas Eve. And then we started an uptrend that's very unusual, because normally when you get a big cascade like that, you come back down and you test the lows and you make what's known as a W-shaped bottom. This time is different, and I really and rarely ever say that in my 50-year career on Wall Street. And here's why I think it's different. Let's start out by putting pullbacks into perspective. Since 1945, there have now been 29 declines of 10 to 20% in the S&P 500 index on a closing basis. We call that a correction. Beyond 20%, it's a bear market. These corrections typically average 13%. This one was 19+%. They usually average 4 months in length. We peaked on September 28th. This one lasted roughly 3 months. But the good news is you recovered to new highs within 3 months. I think we're in that 3-month recover to new high period. And here's why. Normally, as I said, when you see a big waterfall decline, you get a spike in new lows. This is a 4-year chart from stockcharts.com of the S&P 500 on a weekly basis. There are 3 examples here in late 15 and early 16, and then again in early 18, where we had steep waterfall declines, where you got a spike in new lows, and then you came back down and tested those lows, but the number of stocks making new 52-week lows diverged, giving you a positive entry point. Look at that steep decline in new lows on December 24th. And now look at this straight up advance toward 2,800 through the 2,600 resistance. So why is it going to be different this time, in my view? Well, first of all, in the first 2 rallies from 2,600 to 2,800, no breadth thrust. Marty Zweig, an old friend of mine, discovered a pattern over 30 years ago, published a story in Barron's that said if you have 2 days of up volume thrust within a 10 trading day period, and that's what we had in January, where 95% of the volume is in the up stocks. If you're familiar with the tick index and the ARMS index, this is the ARMS index basically. That's very bullish 6 to 12 months out. So let's see how bullish that is. This is a chart of the Zweig breadth thrust going back to 1962. This is 56 years of data. Every red dot is an example of a Zweig breadth thrust. And the key columns to focus on here are the last 2 on the right. Over 6 months and 12 months after a breadth thrust, and that happened in January, 80% of the time the market is up. A year later, and the average gain, actually the median gain, 19%. The breadth thrust occurred at 2,500. Add 20% to 2,500, you're at 3,000. That's a new high on the Dow. Here's another way to look at it. 2018 was a midterm election year. Going all the way back to 1950, this chart is courtesy of LPL Research and FactSet. You make a low in the midterm election year. It's the worst low of the 4-year election year cycle. But the good news is the average return a year after the low, 32%. Add 32% to 2,350, you get 3,050, 3050 again. So we're looking for a high sometime in 2019 based on past history and the very positive market dynamics. Market breadth is extraordinarily strong. That's what the breadth thrust shows. We're looking for new highs in the 3,000 to 3,100 range. We're now at 2,750 roughly after today's decline, 2,760. We're getting a lot of final hour buying. This is a very bullish pattern. Smart money typically buys in the final hour of the day. The public typically buys on the opening. We saw that again today. We had the first sort of mini pullback that we've seen in 8 trading sessions, but in the final hour, buyers came back into both the NASDAQ and the S&P 500. Now, what's the economy saying? Well, in December, as the market was making the panic lows, all we were hearing on CNBC is recession, recession, recession in 2019. And the reason that was important is recessions and bear markets go hand in hand. The only bear market I've lived through that wasn't accompanied by a recession was 1987, where you had unwinding of some god-awful insurance protection that people had bought into. I look at 4 fundamental indicators that have reliably turned down before every recession since 1950. Leading indicators from the Conference Board turned down between 8 and 24 months. They're not doing anything right now. They're not even barking. 12-month moving average of housing starts turns down before every recession. The other 2 that I look at, the yield curve inverting, but that's not an immediate recession. You actually get a rally to new highs after that, and unemployment claims spiking up. Now, that was bothering people until today. Unemployment claims came in lower than expected. So if there's no recession due in 2019, what happened in December? Well, fear gripped the market. CNN has a sentiment indicator they call the Fear and Greed Index. It's a contrary indicator. A month ago, it was in deep fear territory. A year ago, in February of 2018, as the market was making a W bottom, extreme fear. Now we've rallied up toward greed. That's not bearish. It's an indication that panic is over. So if fear gripped the market, what do we want to do here? Well, if you're bearish, after all of that analysis, and you're entitled to your opinion, you can use one of our favorite option strategies, a bearish vertical put spread. You can hedge a 4% decline in the SPY for only $299. You buy the 279 put. When I did this before the opening, that was slightly in the money, and you sell the 268 put against it. You reduce the cost of the put from $469 to $299. And if the S&P drops by 4% by the first week in April, 270% profit potential. So it's a very cheap way to hedge a portfolio. Let's say you have a 401k plan with $278,000 in it. You buy 10 of these spreads, $3,000 cost. You can stay long the market knowing that if we get a 4% pullback, you're protected. Very powerful way. If you're trading from the downside, it's a way to participate in the broadest index. Now, we're bullish, so I want to ignore the headlines. People are screaming recession, bear market. And here's proof of that. Earnings move the market. But this headline was in the New York Times. Now I'm going to ask you a question. Do you think this was in the New York Times business section? It's a Sunday headline. If you believe that, type a big B in the question box. And Josh, give me a read on that if you would. Headline reads, are you ready for the financial crisis of 2019? Here are 5 ways things could get bad for everybody. And we're seeing a lot of Bs.
Yeah.
Guess what? This was in the Sunday style section. That on December 16th, a week before the low. That's what gave me some confidence that panic had gripped the market, and panic always leads to better days. Now, right after that, on the 18th of December, Jeff Gundlach, who's the most successful bond manager in America, said U.S. equities are entering a bear market. And that was followed up by Alan Greenspan, the former Fed chair, who on the 18th of December said investors should run for cover. And this isn't anything new. Back in 2017, 2 years ago, New York Times, caution signals are blinking for the Trump bull market. You've got to ignore the headlines, have a plan, stick to it. Earnings move markets. So we want to be following Warren Buffett, who said famously, investors should be fearful when others are greedy and greedy only when others are fearful. Now, there was a huge opportunity in December. A lot of people went to the sidelines, haven't even gotten back in. So the 74% of you who are making money are on the right track. So if we're looking for opportunities, The problem is what to buy and when to sell, and our solution is Chaikin Analytics for both iPad and desktop. We're going to show you chart after chart with our options play module generating the option strategies. As I said in the beginning, I've always felt that fundamentals drive the market, but emotions drive the market to extremes, and we sure saw that in December. So for me, the path to profits in both swing trading and options trading has always been a combination of fundamentals and technicals. And even if you're investing your 401k plan in an intermediate to long-term mode, you want to be aware of the technicals, and we're going to show you exactly how easy that can be. Now, because we have this unique approach of combining fundamentals and technicals, some of our old institutional clients like Fidelity Management, Soros Hedge Fund, Paulson Hedge Fund have become subscribers to Chaikin Analytics. More importantly, for options traders, people like John Najarian and John Carter at Simpler Trading and Jim Cramer have become big fans of the Chaikin methodology because it combines fundamentals with technicals. It's unique in that regard. So in today's webinar, we're going to show you how you can create profitable options trades in these volatile markets. For me, volatility and fear equals opportunity. If you follow the Chaikin Power Gauge fundamental ratings, which we're going to get into in a minute, use options play module or some methodical way to have high probability options strategies and know which ones to follow and which ones to pass on, and have rules-based entries. Those are the three things that you need to do to create profitable options trades. Now, I'd like to start out with a very short options primer. For some of you, this will be options 101, but it's still important to review this. Simplest way to use options: if you're bullish on a stock, buy a call option. If you're bearish on a stock, buy a put option. You pay a premium, that's your only risk. Problem is, options have an expiration date. And in the 30 days leading up to expiration, you have what's called time decay, because options are a wasting asset. So unless that option is in the money, the value is dropping every day. One of the ways to take advantage of premium decay is to use vertical spreads. Vertical call spreads when you're bullish, vertical put spreads when you're bearish. You buy an option that's in the money and you sell an option that's out of the money, same expiration date, different strike prices. You reduce the cost, as we saw in the S&P example. So we're going to be looking at vertical call spreads and then one or two vertical put spreads over the balance of the webinar. But everything for us starts with the Chaikin Power Gauge rating. It's a very simple display, but there's a lot of number crunching going on under the surface. I like to say on these webinars that the Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. Lots of number crunching, looking at the fundamental data that big institutional investors look at every day. And now we have ratings for all liquid equity ETFs. So the Chaikin Power Gauge takes all that fundamental data on the right and really makes that complex data very simple, because it combines it into a rating that you see on the left for Starbucks. And when I did this screenshot a couple of months ago, Starbucks was 65.92 with a very bullish rating. Notice that the financial metrics that we're going to look at on the next slide were actually bearish. It's a weight of the evidence. Doesn't require everything to be bullish. That's the beauty of the Power Gauge rating. 4 primary factors that look at value, growth, technicals, and sentiment. These are the factors that successful money managers look at every day. This is what I learned from my institutional clients and colleagues when we had an institutional brokerage firm. The value metrics are 35% of the model, but as we saw with Starbucks, the financial or value metrics can be bearish, but the stock can still have a very bullish rating if the growth metrics are positive, if the technicals, even though they're only 15% of the model, are positive, and the key sentiment indicators. Now, we just ended earnings season. During earnings season, companies surprised to the upside or the downside. After the close, Hewlett-Packard Enterprises, a stock that has a bullish Chaikin Power Gauge rating, reported a positive earnings surprise and jumped 4%. Tomorrow, analysts are going to evaluate that. and probably raise their estimates for the rest of the year for 2019. And that's what I learned from a colleague of mine, George Douglas at Drexel Burnham in the mid-'80s. George is still running quant money out in Santa Monica to this day, 30 years later. George did the original research on earnings surprise and earnings estimate revisions. Earnings surprises, he taught me, come in bunches. There's never just one of them. And that's why they persist over time. So if you get a stock that reports a positive earnings surprise, as many of the software stocks are in this earnings season, it leads analysts to raise their earnings estimates, and earnings estimate revisions are the single biggest short-term driver of stock price movement. And this has been true for 50 years since I've been in Wall Street. We also think industry group relative strength is very important. That's why it's one of the 20 factors in the model, and we're going to show you how both Dan Russo, our chief market strategist, and me have been using industry group strength within Chaikin Analytics to find the best industry groups and the best stocks in those groups to trade both options and to use for swing trading purposes. Now, John Carter, who's arguably one of the best options traders I've ever met, saw the Chaikin Power Gauge rating almost 3 years ago and said, this is an objective, awesome meter for stocks. A lot of hyped up tools out there, but when I find something interesting, I'll let you know about it. So you can imagine that a single tool that combines 20 plus technical and fundamental factors got my attention. It's called the Chaikin Power Gauge rating, and it's an awesome meter for stocks. But the proof is in the performance. Here's the performance of the Chaikin Power Gauge rating on the Russell 3000 index from 1999 through the end of 17, pretty much the same in 18. We're updating the numbers now. The very bullish stocks in that 20-factor model had averaged a 20% annualized return. Very bearish stocks up only 1%, and that's after a 10-year bull market. If we were showing you this slide in 2012, the very bearish stocks would have been down 4 or 5%. It's that spread between very bullish and very bearish that you need to be aware of to be a successful options trader. You want to focus your long trades on the very bullish stocks and the short trades or the bearish vertical put spreads on the very bearish stocks. Now in 2015, it really mattered because there was actually a bear market in small caps and energy stocks in 2015. These were the fracking stocks that were everybody's favorite. Range Resources, Kinder Morgan, Pioneer. Small caps in general were in a bear market. The average very bearish stock in the Chaikin Power Gauge rating in 2015, down over 17%. Now think about that. So many people got caught in Kinder Morgan from 40 down to 10. In Under Armour from 45 down to 12. Power Gauge rating identified these stocks. Does it work 100% of the time? Hell no. But if you see a bearish Power Gauge rating, as we'll see in a minute, it's a warning sign that something isn't right. And if you're long that stock, you want to be getting out and looking for short opportunities. Now, Jim Cramer has looked at the whole Chaikin process, not just the Power Gauge rating. And he said, I want to explain why I love Marc Chaikin's stuff. It's simple, it's understandable, it's rational, it's not emotional. There's that emotions coming into play again. And you know I use it constantly, I almost never want to go against it. So here's the methodology that Jim Cramer likes so much. We call it the classic Chaikin bull. Power Gauge rating, which reflects the fundamental potential of a stock over the next 3 to 6 months, is bullish. Now that also works for shorter term traders because the best stocks for the next 3 to 6 months typically do well over the next 3 to 6 days and the next 3 to 6 weeks. Stock is outperforming the market. We have a unique heat map of relative strength, and Chaikin Money Flow, which many of you use on your online brokerage platforms or on stockcharts.com, is bullish, indicating that institutions are accumulating the stock. Now here's a 1-year chart of Salesforce. I love this company. Jim Cramer sort of turned my eyes on this. Great management, cloud computing, unique business model. We read the chart from the bottom up. Why? Because the Power Gauge rating is at the bottom of the chart. That's your directional edge as an options trader. Power Gauge rating was bullish. didn't mean you couldn't decline. As we'll see a little later, we had a bullish vertical call spread that we recommended on a webinar on December 20th. Enabled people to take the heat of that final leg of the downtrend when you didn't make a lower low. More importantly, stock was outperforming the market for most of 2018, and it's outperforming the market again. And institutions were buying the stock. So everything you need to know about a stock to decide whether you want to put on an options position or swing trade is on this chart. Buy and sell signals, color-coded earnings. You can tell whether a company has surprised to the upside because we color-code the earnings icon green. And then you have this wonderful relative strength buy signal right after the December 24th low. Let me tell you what the relative strength buy signal is comprised of. It's really simple. You can use stockcharts.com or your online brokerage software to spot these. Stock is outperforming the market. In our case, our relative strength indicator is green. It dips below its 21-day exponential average, that's the middle line, and then rises back above it. When it rises back above it, it triggers a relative strength buy signal. Why is this so important? Because these signals are 70% accurate historically, and they last for 4 to 8 weeks. So you can put on an options position, weather a couple of down days in the market and the stock, knowing that the persistency is likely to be there. And you see 3 signals on this chart. They all worked. And look how they last 4 to 8 weeks. You can make a lot of money in a bullish vertical call spread or just by buying calls outright with confidence, knowing that you're going to lose 30% of the time, probably make money 70% of the time, but your winners are going to be huge. Now, the classic Chaikin bear was really important in 15. It was also important in 18 because a lot of stocks, as we'll see, that were very popular took a big dive, not just in the fall of 18. So power gauge ratings bearish, underperforming the market. Chaikin money flow is red, not green, telling you that institutions are selling the stock and you should be selling it also. So here's Wynn Resorts. This was our poster child for Chaikin bear all through 2018. So reading the chart from the bottom up, power gauge rating was bearish, underperforming the market, relative strength is weak, and institution selling, and we know that because Chaikin money flow is red, not green. Now we're going to give you an advanced look at a very special pattern that we're going to talk about a little further along in the webinar. We call it a Chaikin bearish money flow sell alert. It happens when a stock gets overbought and Chaikin money flow stays red. Now, if you get a 5 to 10 day rally in a stock, Chaikin money flow was constructed to go green, to oscillate around that zero line. If it doesn't, it means institutions are selling into the rally. They're not participating or creating the rally. So you get overbought, Chaikin money flow is red.
ASME control.
And that's bearish money flow sell alert. We're going to get into that a little more. You can spot this on stock charts or on your online brokerage platforms. We put it all on one screen in Chaikin Analytics. Now, summing this all up, successful trading demands a disciplined methodology. That's encapsulated in this pyramid, and the Chaikin power gauge rating gives you a directional edge. So at the top of the pyramid, the power gauge rating, we also think, as we said earlier, industry group strength is really important. The bottom of the pyramid, just those 2 technical indicators, Chaikin money flow and Chaikin relative strength. And then in the middle, the sweet spot, buy and sell signals. Very important, obviously, for options trading. We have 6 pairs of buy and sell signals in Chaikin Analytics. You can go to our website, chaikinanalytics.com, and we explain the rationale between each of those behind each of those 12 signals. There's a few proprietary twists, but you'll get the general drift, just like with the relative strength buy signal. Now, it's nice that there are signals out there, but it's even better that you know what they are and when they happen on the stocks you're interested in. So we have dashboard alerts in Chaikin Analytics. This is a screenshot from my iPad version on January 8th when a number of stocks gave relative strength buy signals, including MasterCard. So MasterCard was 189.76. There's the signal where that yellow arrow is. It had just begun outperforming the market in mid-December. It's about a month later. And the stock went from 190 to 221. Relative strength signals really work. There's, again, 2 more on this chart. And then the power gauge turned bullish in late January. Look at the Chaikin money flow. It's as strong as it's ever been in the last 12 months. Institutions are accumulating the stock, and you got a positive earnings surprise, which pushed it above our long-term trend line, and the stock has just kept going. That's another thing that encourages me about the market. In the previous 2 earnings seasons, in July and October, you had a sell on the news mentality. Company reported positive earnings, spiked up, sell on the news. In this earnings season, stocks are very often continuing higher, making them difficult to buy, so you've got to get into them in many cases before the earnings report. Now, we also push these alerts because we got feedback from our subscribers that said, I might be traveling, I may not sign on to Chaikin Analytics on a given day, I may want to look at it on the weekends. So we push the alerts. We started this last May on your primary watch list and on any other large list like the S&P 500. So on November 9th, I got a push alert at 8 o'clock in the morning that 2 energy stocks, ConocoPhillips and Holly Frontier, had triggered sell signals. Holly Frontier triggered a relative strength sell signal at 65.74. Now, based on what I've told you, what would you expect to happen after that relative strength sell signal, especially because we were in part of that big waterfall decline? I think you'd expect it to drop, and sure enough, it did. At that yellow arrow, 65.75, Holly Frontier gave a sell signal. Power gauge was neutral, but it had been underperforming the market. Chaikin money flow was negative. There's your bearish money flow sell alert, and the stock dropped from 65.75 all the way down to 46. Then you got another chance to do it again at 60. Now, right before that sell signal, Holly Frontier went from outperforming the market, so relative strength was green because we loved the refining stocks back then, to underperforming the market. We call that a bearish personality change, and I'd like to show you a couple of examples of that because this is a really powerful pattern. It helps you avoid putting your feet in cement because we were bullish on the refining stocks, on Marathon, on Valero, on Holly Frontier, on Phillips 66. But when they start underperforming the market, you've got to be flexible. So the key to making and keeping profits for me has always been that flexibility, spotting personality changes ahead of Wall Street analysts, ahead of the rest of the world. So we define a personality change as a stock that goes from outperforming the market to underperforming the market. And it helps avoid being on the other side of that door when Jack Nicholson's coming through with the axe, because that's what it feels like when you're long a stock that's making new lows. So here's a good example of a very popular stock, Applied Materials. They make semiconductor manufacturing equipment along with Lam Research. They were big, big winners. The stock went from 16 to 60 in 2 years. And along the way, the power gauge went from bullish to neutral. And then in April of 18, bearish personality change. Institutions were selling. When we see that, we look for the first sell signal. It's not an immediate sell. We look for the first sell signal. In this case, we got a relative strength sell in late May at a price of around 50. Another one here ahead of earnings in August. And the stock ultimately bottomed at $30. That's what a personality change can do for you. Now, notice at the bottom that the power gauge rating turned bullish in mid-January when it went above this long-term trend line because the underlying fundamentals are still strong, and now it's outperforming the market with institutions buying and has reported a positive earnings surprise. Now it's spiked up. It's been pulling back. We're looking for a buy signal now to get in to aim at. You got to be flexible as a trader, as an options trader or a swing trader. Now, we talked about the bearish money flow sell alert. Let's show you two more examples of that. These are really powerful patterns for options traders because not everybody is following them. There's not like candlestick patterns or moving average crossovers where you're in deep company when you're trading on them. They work sometimes, but everybody else knows about them as well. So here's Mohawk Industries. It's a carpet company. It was affected by negative vibes and industry group strength in the housing stocks. This is a one-year chart. Power gauge rating was bearish through almost all of 2018. Underperforming the market, institution selling. It's a classic bear. And look what happens when the stock gets overbought and Chaikin money flow is red. Call that a bearish money flow sell alert. You got another one here. And after a few days of sideways movement, you broke down. The first one came at a price of around 230. Stock bottomed out below 120. The real mother of all money flow sell alerts on Mohawk was off the charts. It happened about 14 months ago when the stock made a new all-time high at 260, just as we saw Apple give us a bearish money flow sell alert when it made that new all-time high at 230. Now, why did Chaikin money flow stay negative on that? Look how it had rallied on each of the rallies into heavy green territory, pulled back, but on that rally from about 212 all the way up to 230, do you think the institutions were buying it? No. Smart money was getting out of Apple at 230. And the way we know that is Chaikin money flow never turned green. It looks back over 21 days, so it had plenty of opportunity to catch institutional accumulation. It never happened. Gives you the ability to take money off the table if you're long Apple because the power gauge rating was bearish and it was outperforming the market. So we wouldn't go short Apple at that point, but we would definitely take money off the table. Now follow the progression. The power gauge rating turned bearish at 212 on 1028 right there. And then you had a bearish personality change and the stock dropped from 212 all the way down to 140. Still underperforming the market in spite of a positive reaction to earnings. These are our overbought sell signals that come on new 8-day highs in stocks with bearish power gauge ratings. They're usually good short-term entry points, good for 5 to 10 trading sessions. Apple right now is going nowhere. And the reason we're not looking for buying opportunities in Apple, power gauge rating is bearish and it's underperforming the market. That discipline will help you year in and year out. Now, we talked about industry group strength helping to pinpoint winners. Both Dan Russo, who writes our morning market commentary that comes out before the opening, and every 3 weeks writes Chaikin Market Insights on Sunday, and I both believe that industry group strength is the key to pinpointing winning stocks. If you're trading on the long side in stocks in strong sectors and strong industry groups, and we have two different ways to measure strength, you've got a tailwind, and your long profits are going to build up much faster. On the other hand, if you're trading to the downside, you want to be shorting weak stocks in weak industry groups by using vertical put spreads. So here's an example of how we analyze industry groups. We're looking in Chaikin Analytics at the 22 Standard & Poor's. They call them subsector ETFs. They're really industry groups. And we have two ways to do it. We now have that new power gauge rating for ETFs that combines fundamentals and technicals. So this graph ranks the 3-month performance of these sectors, and we can see software is up 20% over 3 months, much more than the S&P, followed by innovative technology and semiconductors, all with bullish power gauge ratings. The second way we look at it is proven, tried and true. We've been using this since 2011. We call it the Chaikin Power Bar. It's the number of stocks with bullish versus bearish power gauge ratings in any industry group, index, list that you choose. In this case, going into today, 55 stocks in the software group had bullish ratings. Only 3 had bearish ratings. Here's a chart of the XSW. That's a tongue twister. I say it slowly. Power gauge rating is bullish. It's been bullish almost all through 2018. The group is outperforming the market. In this case, that's the ETF, XSW. And look at the Chaikin money flow. People are using the XSW to get exposure to software stocks. On the left, we see all the very bullish stocks listed. You can scroll down and see more of them. We're going to look at 4 of those stocks right now. We've circled Cadence Design, Cognizant, and Nuance. So let's look at Cadence Design. Power Gauge has been bullish for almost 9 months, since May, with a little excursion into neutral. Outperforming the market, very strong accumulation. And right here in my weekly market insights that comes out every Sunday, I made Cadence my bullish stock of the week on January 27th. It was 46.59. It dipped down under 46, which was our ideal buy point. And the stock reported a positive earnings surprise 2 days ago and spiked up to 57. That was your shot to take money off the table, because this stock never gave you another entry point. And in fact, in our weekly market letter this Sunday, we said, time to take some money off the table when the company reports earnings. Sell the spike. In this case, it's done a pretty good job of holding that gain, but that's your earnings opportunity. Now, Dan Russo, when he wrote Market Insights on February 10th, made Synopsys his bullish stock of the week. It was 94.79. Power Gauge rating had turned bullish at about 92. Stock reported a positive earnings surprise yesterday, spiked up to 103.50. Great opportunity to get out of the stock. Let someone else take the risk at that point. So the top-down process of looking for strong industry groups with bullish power gauge ratings and a preponderance of bullish rated stocks, and then finding the best names in the group, has worked very well in both bull and bear swings. So let's look at 2 of the stocks that have recently given buy signals in that group. In fact, they gave oversold buy signals today. What does that mean? It's an 8-day low in stocks with a bullish power gauge rating that got oversold. So Cognizant Technologies, very fine software company, just recently saw the power gauge turn bullish and start outperforming the market. There's your bullish personality change. So it's an oversold buy, and now we go to options play to see if there's a good vertical call spread. And in fact, the options play rating for the vertical call spread that expires on April 5th, only a 77 circled in red. 128% return potential. Options play would rather you bought the stock. Bad options play score. Now, Nuance, which makes voice recognition software, also gave an oversold buy signal this morning. Made a new 8-day low. Power gauge is bullish, pulling back to support. This is a very advanced technology company. Let's see if there's a good options play. Well, options play gives us a 103 rating with a green check mark, suggesting that you could buy the April 16 call that expires on April 1st, sell the April 18 call against it. Your total cost of the trade is only $75. You could put on 10 of these spreads for $750 and be long the equivalent of 1,000 shares of stock, hoping that it goes from 1632 to 18 by April 1st, knowing that your only risk is $750. You can sleep at night and let the Chaikin methodology work for you. It's not going to work every time, but 70% of the time, the relative strength buy signals work. About 66% of the time, the oversold buy signals work. You're looking for it to go to 18, which is the area of the old highs. Now, in addition to finding strong stocks and strong industry groups, we think you should be looking to buy vertical call spreads on stocks that are making new highs or breaking out when they pull back. We don't want to chase the strength. We want to look for them to pull back like Cognizant and Nuance did. So there are 4 stocks that I'm watching. And again, these are not recommendations. They're meant to be examples and stimulate your own research. Bank of America, which I made my bullish stock of the week this Sunday. Boeing, which was, as we'll see, has just been skyrocketing. Salesforce.com we've already looked at, and Starbucks. So here's Boeing. The ideal buy point was that oversold buy signal down here at 28 about a week and a half ago. But with the stock around 29, outperforming the market, bullish power gauge rating, institutional accumulation, let's see if there's an options play spread. And sure enough, there is. Even after that rally from 28 to 29, options play analytics show that if you buy the 29 call expiring on April 5th and sell the 31.50 call against it, you've got a profit potential of 184% if Bank of America goes to 31.5 between now and April 5th. Now, the finance stocks haven't participated in the market, but they're starting to look better as interest rates have bottomed out and appear to be going up a bit. You could put on 10 spreads for $850 and control $29,000 worth of stock. Your total risk is the $850 plus commissions. And your profit potential is close to 200%. And again, you don't have to watch this trade every day. You know what your risk is. You'd rather not lose 100%, so you got to monitor it, but you don't have to sit in front of the screen. Put the position on. If the market continues higher, breaks through 2,800, finance stocks lead the way, big banks. And by the way, Warren Buffett added to his positions in 4 banks, Bank of America, JP Morgan, US Bancorp, and PNC. The only one with a bullish rating is Bank of America and Chaikin Analytics. That's why I made it my bullish stock of the week. Boeing, been bullish, outperforming the market, but once they reported that positive earnings surprise, there was just no way to get in. So you don't want to chase it. You want to wait for a buy signal, but you do want to be long Boeing. The industrial stocks, in addition to technology, have been leading the market to new highs. Salesforce we looked at earlier as our classic bull. On a webinar we did on December 20th, we used a vertical bullish call spread on Salesforce as an example of what you could do in options play. Salesforce was outperforming the market. It had rallied better than most stocks into the November peak, and it was trading at about 133. So on that webinar, we talked about buying the 133 call that expired on February 1st, selling the 150 call against it, reducing the cost to $600 per spread to control $13,000 worth of stock, and there was 182% profit potential. And sure enough, by April 1st, the stock had rallied to 150, and you could take your profit. It's continued all the way to 163. And right now, it's overbought, so we don't want to put on a vertical call spread. We want to wait for it to pull back to that 21-day average or below, and then look at options play to see if there's a high probability spread. Now, right now, you could put on the 150, the 160 spread and sell the 177. It's just too high. You want to wait for it to come in. Now, Starbucks, we use that as a screenshot example of a bullish stock when we showed you the 20 factors. It gave a relative strength buy signal just as Salesforce did right after the December 24th low, and the stock has gone from 64 all the way to 71. Again, too high to put on an options position. You want to wait for a pullback. You want to be patient, follow the discipline, and then look and see if there's a high probability bullish vertical call spread. Now, if you're bearish on the market or looking for downside opportunities, the power gauge rating on Amazon has just turned bearish. Now, Amazon is a $1,622 stock, so I don't think too many people are prepared to short 100 shares of Amazon and commit 161,000 or 82,000 in a margin account with all that risk, unlimited risk if the stock goes against you and goes up. But if you've got a big enough account, you could put on a bearish vertical put spread. Cost you $3,733. So Amazon has to drop roughly 37 points to make this profitable. That's not much for a $1,600 stock. And if Amazon drops down to 1,500 by April 5th, you bought the 1620 put, you sold the 1,500 put against it, you reduce the cost of the put from 53.75 to 37.30, you could earn a 222% return if Amazon goes down to the lower band at 1,500. With the market high, if you're bearish or if you're looking for a downside play, Amazon is a possibility, but $3,700 is a lot of money for a spread. So you would only do this in a $50,000 or $100,000 account. If you've got a $10,000 account, you don't want to risk $3,700 on a given trade. You never want to lose more than 2 to 5% of your equity on any one trade. So you've got to have a bigger account to play in the Amazon option spreads. Now, let's look at Starbucks as a real favorite. We've already looked at that, but let's look at it again because everything is in place. Power gauge rating is bullish, outperforming the market. Institutional accumulation, it's a turnaround story. Just wait for that pullback and look for the options opportunity. Now, everything we've looked at is in Chaikin Analytics. It's a proven stock selection system. It's been out there since 2011. We have over 3,500 subscribers. We have the options play ideas module built in, and we have those daily email alerts that alert you to signals when they happen. Normally, an annual subscription, $2,195 a year. You can go to chaikinanalytics.com/options. But as a webinar special that expires on Sunday, we'd like to offer a $300 discount, reducing the cost of a one-year subscription to $1,895. But we have a special fast action bonus in 2 slides, so stay with me. You get our screener, which we didn't get into, where you can find great stocks that meet your criteria. Small caps are outperforming the market. You can find them in the screener by using our small cap universe and looking for very bullish stocks on pullbacks. You get the options play ideas module, and most importantly, as a Chaikin subscriber, you get member-only access to our weekly strategy webinar with our market strategist, Dan Russo. Unlimited coaching, including one-on-one coaching. Josh Minlin, who's curating today's webinar, is our options specialist. And you get Dan Russo's daily morning insights with a bullish or bearish stock of the day. So as an inducement for you to call now, we'd like to offer you a fast action bonus. Subscribe today, call in now, and we'll take an additional $100 off. And for the first 10 people who subscribe to Chaikin Analytics, we'll give you a one-on-one phone call with me once you've had a chance to learn the system so we can make that a valuable experience for you. $1,795, and for the first 10 people who call in tonight, one-on-one phone call with me. Thank you very much. Josh, I'll turn it back to you to wrap up the webinar.
Thank you, Mark, and thank you everybody for attending today. To take advantage of Mark's incredible offer and to get a one-on-one with Mark himself, you can go to www.chaikinanalytics.com/options, or you can call us at 877-697-6783. I chatted in the chat window the link. The discount code will automatically be applied, so you can just click on the link right in the chat window and go directly to the sign-up page. Again, that's chaikinanalytics.com/options, or call us at 877-697-6783. We can get you onto our onboard session immediately. You'll have access to everything that Mark just talked about and more. Again, that's 877-697-6783. Thank you, everybody, and have a great night.
Wow, 53 minutes. Give you some props. I'm just relaxing. Let me get back to that research. for you to wrap up. You tell me when you're ready. Go ahead, next 5 minutes. It was great, 53 minutes. You want fast? I give you fast. No, I know. It was 68 slides. A lot of great examples, a lot of options examples, new flow, really good. Moving very fast. Yeah. Yeah, I mean, it keeps me going. Yes, big.